Bob Clark,
Present.
Kathy Finn, okay. Paul Hample.
Here.
Sharif Mansouri. Who's there? Captain Aaron Schaefer,
Here.
Milt Wilkins,
Here.
Levon.
Here,
Oh,
sorry.
Levon is present.
thank you, Levon.
And the Sharif.
Matt Levinson.
You had to figure out how to unmute it.
And Pepe.
Yeah.
Oh,
Heard.
I had a little issue.
All righty, very good. Let's go to the approval of the minutes from the last meeting. So move.
Second.
Any comments? Okay, it's been moved and seconded. All those in favor of approval of the minutes of the regular meeting, we'll talk about the closed session in a moment. The regular meeting? All in favor?
Aye. Aye.
That's unanimous. Okay, approval of the minutes of the closed session of last month. May I have a motion?
So moved.
Second.
We'll get Pepe the second, just so she can be recorded in the annals of the county.
How about I'll do it? Seconded.
You can have two we only need one. I'll save your second for another
You
motion.
get the next one,
Okay.
Sheree.
All righty, a request for benefits. Civilian. Did we not?
We did.
Okay, fine. I thought we had. My fault. All those in favor of approval of the minutes of the closed session?
Aye.
Aye.
Okay, now it's unanimous. We've done it. Good for us. Okay, item number 4, request for benefits. The civilian requests,
So moved.
there are a lot of requests here. Is there anything going on? Is this simply a time of year when there would be more retirement requests than others?
I'll second that.
Okay, who,
I moved.
okay, Scott and Paul. All those and I take it there are no controversies here, right? Okay, all those in favor of approval of the request by civilians for retirement benefits, say aye.
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 Any opposed? Next item is approval of the request by police for retirement benefits. There are 3.
Make a motion to approve. Second.
Captain Schaefer and Scott. It's been moved and seconded. All those in favor say aye.
Aye.
Nice.
Aye.
That is also unanimous. We're on a roll. All right. Beneficiary applications for death benefits. First, the civilian requests, actually 6 deal with Ms. Schaefer, which is unfortunate, but there are 6 beneficiaries there. So moved. Paul, may I have a second?
Second.
Scott, Vichu, that'd be in this case. All right, may I have a Paul, second, and may I have
Paul,
a
motion.
motion,
Scott,
yeah,
second.
vote for approval?
Aye.
All those in favor?
Aye.
Any opposed? There are only 2 police requests.
Make a motion to approve.
Captain Schaefer, I'll second that. So I get my name in front. All right, thank you. All those in favor of the request for police death benefits?
Aye.
Aye.
Any opposed? Okay, now, both Sharik and Paul Bauer have time constraints. So I'm going to change the order here a little bit. I would like to take up item number 7 now. At the last meeting, we covered the actuarial report. Pepe participated by phone. Sharik was unable to participate at all. I just want to make certain that everybody, upon reflection, has had their questions answered or would like to raise new questions or make new comments about the actuarial report. So that's why I'm putting this back on the menu. If there are no questions or comments, then we'll just press on. Floor is open for questions or comments. Members of the board on the actuarial report. Paul, were you able to
Yes,
do
sir.
were you able to do the analysis that I requested?
I did. I put something together this morning, Milt. Can you
Okay.
hear me okay?
We can hear you fine.
Okay, so when we talked last month, I told you that as of 1/1/2026, the St. Louis County plan is funded at about 68%. And we discussed how you can compare yourselves to other plans, but it's important to keep in mind not just the funded percentage, but also the interest rate they're using to calculate their liability. Because if you had used a 10% interest rate, your plan would be much better funded than it is currently. So you all are at 68% using a 7.25% interest rate. I found 5 large plans within the state of Missouri to compare yourselves against for just comparison purposes. The 2 that are most similar to you in interest rate are the teachers' plans, Piers and PSRS. They are using an interest rate of 7.3%. Both of them are right at 90% funded. Piers is 90, PSRS is 89%. Okay, so they're about 20% higher than you are at the same interest rate. Okay, right in there is then Loggers. They're using a 7% interest rate, but they're 92% funded. So I'd argue that they're a little better than, they're probably the best of the group. Right below them then is St. Louis Police, which is using a 7% interest rate, but they're 81% funded. So less than those 3, but still higher than you all. The one that has me scratching my head is Moser's. Moser's is using 6.95% as their interest rate. And at least from what I could take from their evaluation report, they are 55% funded. So congratulations, you're better than Moser's, but I'm not sure what's going on with that one. They're huge, but I was shocked by that one.
Paul, were all of these funded ratios calculated on the actuarial basis or market value basis?
I would say this is a hodgepodge, Milt, based on what I can readily find. I will also clarify that a lot of these are based on prior year information. They haven't posted their 26 reports yet. So it's a little dated, but it at least puts you in the right ballpark. From a market value to actuarial value, I believe like Moser's, their 55% actuarial was an actuarial value. The teachers, both of those were from a GASB reporting. So it's an accounting basis. So it's going to use a market value. So it's a little bit of a hodgepodge, but at the end of the day, you aren't going to get wide changes in those rates simply based on the assets you're using. I mean, if I'm telling you it's 90%, if I used a different basis, it might be 92, it could be 88, but it's not going to be 70. Does that make sense?
Yeah, since we're on a calendar year fiscal, it's quite probable that a number of other plans are on a calendar year fiscal as well. So why don't we put in our bring up file for October or November, because by then everybody would have published
Yes, sir.
their actuarial report by that time. So let's put it up, put it as a bring up item in October and see if we can get a more contemporaneous as well as comprehensive analysis.
Makes sense.
At some
Will do.
point, someone from the county council is going to ask a question, at least they should. I don't know if they will, but they should. And we want to be able to respond to their questions with apples to apples data, so to speak. All
Makes
right,
sense. Yes, sir.
thank you very much. All righty, next,
Paul, I've got a question.
please.
Paul, what was the interest rate that Piers and PSRS was using?
They were using 7.3.
Okay. Thank you.
For the
Sir.
record, we're 7.25, is it not?
That is correct.
Okay, any other questions or comments of concerning us? No? Fine, Paul, thank you so much. Appreciate
Thank
you
you, Matt.
do that and do the analysis that you did in such short notice.
Yes, sir.
All right, next item is the performance report from Asset Consulting Group, which is solely responsible for the major sell-off going on in the market this morning. So On that note, you may, with that introduction, you may.
Yeah,
proceed.
we don't get that introduction quite often.
No,
so,
but I'm sure you do.
Perfect. So we have our performance through the end of May. That we'll go through our performance. Our managers did want to take some time where our most of our data here is through the end of May, but as we sit here, last week or so of June, halfway through the calendar year, our fiscal year, have a few pages just on the markets and what's been driving it. And if you flip to page 5 of our deck, it's overall been a very strong year from absolute returns. We'll get into a lot of that really driven by a couple themes, a couple names, pretty concentratedly led as far as returns go. But also it's been a volatile year. That I think that we all know that. And that's what you see here that's on page 5. These are the major areas from the equities on the left, fixed income on the right, where we're allocated. And you can see just by color code, really breaking it down by months. I mean, we combine January and February together, what the returns are for these areas. And then March, really, that's when the Iran war kicked off. A lot of concerns, particularly around energy prices and really the impact on inflation and what that'll flow through to the overall economy. Certainly, then you see rebounds in the markets in April and May. And this purple dot is purple line, I should say, year to date. It's through May. So you can see really strong returns across the equities, led in particular by two areas that over the last few years haven't really been the top performer relative to U.S. large cap, which we talked quite a bit about. Emerging markets up 25, small cap up 18, but still pretty strong from the developed world, whether it's international or U.S. large cap year to date. I'd note, maybe before anything that happened in the market this morning through yesterday, markets pretty positive here in June in particular. Those two areas, emerging markets and small caps, you can add another 3% basically to that in June, bringing their year-to-date numbers, close to around, at least for emerging markets, 30%. U.S. large cap, the one area that actually is sold off a little bit, down 1% here in June. But overall, strong returns. We'll get to in a minute what's really kind of what areas are driving that and what areas aren't from a performance standpoint. And so I thought it'd be interesting, the next page, and we'll what's led to some of these returns. What we thought we'd put here is a little bit, these are some of the key themes on the left that we had talked about, not just us in here, but the markets, what really everyone had their eyes on heading into 26, and really give kind of an update of where things are on the right. And I'll point out just a couple of these. First and foremost, AI, continuing AI boom, continuing AI spend. I got a little bit of data here that I think is interesting, if nothing else, to look at. At just some of the spend that is around, call it these hyperscalers, large technology firms really pushing their development infrastructure in the AI space. That has continued to be a theme. U.S. economy continues to be resilient from an economic standpoint. This was really what led to a lot of that rebound I just showed you in April and May. Even with the higher inflation that we have experienced, everyone expected, particularly given the energy price impact, the economy is continuing to spend and do very strong, and corporate profits are continuing to come in here well. One area, and I know I've talked about this, fourth one down, big difference now versus what expected coming into this year. Coming into this year, everyone thought interest rates would drop. Everyone thought the Fed would probably make 2 cuts this year. In fact, what's now priced in is hikes on the other side of it. Really led by what's happened with inflation, and really that has continued to actually not just moderate, which what it was doing, but raise up, has really caused the Fed and markets. Rates have moved up. With some expectation that the Fed will actually hike this year. This is something that could potentially be a headwind from an economic perspective, right? Higher rates, it's more expensive to borrow. It's more expensive for people that are getting mortgages, that are getting car loans, also for corporations that have to borrow. But on the flip side, from an investment standpoint, right, it's going to continue to benefit us as fixed income investors. We're continuing, what we earn is that yield that we get. Paul just talked about, we're trying to hit 7.25%. We're seeing our bond managers able to have yields of 5.5%, 6% right now, just from our bond portfolio. So that's going to continue to help us out. And what I would say, kind of big thing pointing out, and we'll get into some of this, that second to last bullet point, is we went into this year, remember, keep in mind, we're coming off of some really strong performance years from the market standpoint. So us, pretty much everyone out there was expecting lower returns going forward, right? Valuations were high, things were expensive, not going to have a similar high of returns going forward. Well, certainly that's not been the case so far here year to date. Prices continue to rise. And really it's this in some way, I'm going to get to AI here in a minute, but a lot of this is kind of, we put in quotes that last bullet, half the people is there a bubble? Is this getting too expensive? But of course, everyone has that FOMO, that fear of missing out. And really, do I need to have exposure to this? And ultimately what we've seen, it's been the right that's really led a lot of this from a price standpoint. Investors really buying, pushing up, whether it's SpaceX that came out a week or so ago, or these other technology companies wanting to own exposure to that. So those are just some key themes. Really big in this particularly our portfolio, the markets, has been this continuing strong spend and run up within AI and technology, and markets wanting to own this technology. So first off, what I thought was interesting on page 7, this is just an example, or not an example, but some data our team put together as we went back and they looked at various, big changes to the economy, to the infrastructure, new technologies that came on board, and what the graph is showing as a percent of GDP, what was spent to build out this infrastructure at the various time periods. So first off, the biggest one, 150 years ago was the railroads, right? As that connected America, there was a tremendous amount of spend. About 5-6% of overall GDP at the time was spent on developing railroads. You can see the other, whether it's electricity, interstates, original software, telecom, certainly significant parts. And then you can see actually on the AI, the CapEx, that's the spend these companies are putting in to build the infrastructure. What we're showing in the darker blue is really kind of what we up to date this year, with also the estimates that have been released by the companies for the remainder of this year. But you can see then in this lighter blue shaded area, really what expectations are over the next few years, what companies have said they're going to spend. And this is, rivaling that. You can see all the way back to the railroads. And again, this is from a percent of GDP. So how much of the economy is really invested in this? This has led to certainly that rise in price levels for these companies that have to do with the AI build out, with the spend, with the expectations and hopes of what they're going to be able to deliver. Where we continue to, in some of the markets, some of our managers have a little bit of pause on the valuations of some of these companies, is all that spend that I just showed you, all that spend, that 5-6% of overall GDP, is that ultimately going to lead to corresponding profits from an investor standpoint in these companies? And there's a lot going on this page. It's purposely page 8, Rachel, it's purposely confusing. We put this together. We call it a spaghetti chart, if you will. But what you can see, these circles are various companies. Most of them, a lot of them. And what you see is this interconnecting web, those spaghetti noodles, of how they're making investments within each other, how they're making purchases from each other, and really how interconnected a lot of these larger corporations are. And the point to the right, as we get to this, is what's underpinning all this investment with each other, whether it's buying chips or going in, purchasing companies. There is a tremendous amount of spend that has been going on. The expectations of these top, call it hyperscalers, is spending another $3 trillion over the next 3 to 4 years on top of what's already spent. And ultimately the question is that trillions of dollars worth of spend ultimately going to come back to them even more in revenue? And so just to put it in perspective, and it's in the language at the top, we broke out just OpenAI, for example. It's one everyone's heard of. Over the next few years, they've already said and basically committed to spend $1 trillion in building out their infrastructure over the next 3-4 years. Right now, their revenue is $13 billion. Right, so they're committed over $1 trillion, and they're bringing in $13 billion. Ultimately, that revenue has to grow tremendously in order to compensate for the spend that they're making. And so ultimately, the thought, going back to the spaghetti chart, there is no doubt that AI is changing the world, that there are going to be some significant winners in this. But are all the companies going to be winners? right? Is there enough revenue to come back to them to support everyone for what they put on the side? And so ultimately, as you look at the interconnectedness of all of these, if all of a sudden one of them gets pulled out, doesn't work as well, not that necessarily maybe they go out of business or they just pull back on their valuation, is that going to have some sort of domino effect in the valuations and the revenues earned back from some of these? So that's ultimately, as we talk about high valuations, as we talk about the market really wanting to own this AI exposure, what we've seen is the built up. Ultimately, is it going to come back in terms of profits for these companies over the years to come with what they're spending? And so,
This is an excellent piece of work here.
oh,
This chart, it's an excellent piece of work.
thank you. Like I said, sometimes we try to make it look confusing, but in reality, this is, I think, one of the key aspects to what's driving the market and really what we're thinking about, concerned about going forward. Because keep this in mind, but then transition to page 9 and actually look at how this has impacted returns and what it's done in the marketplace. So we've talked about, I showed you that the headline indices. It's been a strong year from an absolute return perspective. Our portfolio has very much benefited from this. We are currently at an all-time high, higher than we've been in our portfolio. We're over $1 billion now. We'll get to that in our performance report. And a lot of this has been certainly driven by the strong market, but as strong as the market's been, it's really, again, it's been led by a concentrated group of companies whose prices have gone up tremendously as it relates to the market wanting this AI exposure. Just the graph on the top right, this is over the past 12 months, and it's breaking out the returns of the All World Index. So the ACWI Index, All Country World Index, this is not just US, it's large and small within the US, but it's also international. It's developed, it's emerging markets. It was up about 30% over the last year. Half of that return came from 12 stocks on the left. Right, so Craig, there are thousands of names in the index. I don't know exactly what it is off the top of my head, but it's 3,000-4,000 names in this index. 12 of them were half the return. Right, and you can kind of see the companies there on the left. And really the point, as you look at the bottom of the page, is given these huge run-ups, and whether it's Taiwan Semiconductor, Apple, NVIDIA, Google, all names certainly we have in our portfolio. But now as you break out the individual indices, whether it's S&P 500 for US large cap or emerging markets, you can see these smaller groups of names are making up a tremendously large piece of that index. Mm-hmm. What the bottom is showing is the top 10 companies in each of the indices and really what their weight is. And you can see whether it's emerging on the bottom left, emerging markets in gold, the S&P 500 in light blue, the top 10 companies within these index, which have hundreds, or emerging markets has 1,000, is over a third of the portfolio. And that's the same thing broken out on the right-hand side of the page. So ultimately, again, and this is, we're going to transition, we look at our performance. Returns overall have been great, but ultimately it's been led by some of these fewer companies who are spending a tremendous amount, and there's concerns that they get the revenue back.
Now, does that imply we should further concentrate our portfolio or further diversify our portfolio? What conclusion, maybe I'm getting ahead of.
Well, no, that's the exact question that we're going to get to. I think what it tells us is the diversification still matters. Ultimately, valuation still matters. That's what's, kind of in the top left-hand graph, and we've all talked about this, but the industries themselves are getting very, very expensive. And really, it's led by just a few names. And so we do think it's important of having that diversification to protect ourselves when things get really expensive. All of a sudden, the market realizes they're too expensive for what they should be. So that said, now keep in mind, we still do have a pretty significant amount of our portfolio either already in passive strategies or being added to passive strategies, right? Our largest allocation in our portfolio, it's over 125 million, is passively invested in the S&P 500. So we're earning that exposure. And then we're complementing that with 2 active managers on the side who have that valuation component. As you all know, we're currently in the process of adding to the portfolio passive strategy on the international developed side, as well as the US small cap side. So we're in the process of maybe adding more to some of these exposures, but we also think it's very important to have a component of that portfolio diversified to protect and really invest in things that aren't as expensive.
While we are talking about that, do we have an update on the approval and the allocation to that?
So the first one, BlackRock, on the international side, there's been many steps. That still is, it's with the internal St. Louis County team, Sharik. They have a few more questions related to the documentation that they're going back, hopefully with one or two more steps with BlackRock on that.
John, how much longer is that gonna take?
It's with Levon's team. Our office has completed the review and sent our comments to Levon Fiscal Management for their input. And so when he gets it back to us, we'll review it and work on it as fast as we can.
Is Levon on? Is Levon on? No? Okay, fine. I was just gonna ask him the same question. How long is this gonna take?
So that one's in process, and then Northern Trust on the small cap side.
Excuse me, I'm sorry to interrupt. This has taken an unacceptably long period of time. This is a $1 billion organization now by itself. We run $1 billion. We should be able to request county staff in total to respond more rapidly when we're trying to make strategic decisions. Because even though they're strategic decisions and not time-based decisions, it still takes, you want to implement strategic decisions as soon as possible in any event, right? So we've got to figure out a way, and the board can't do this. This has to be county staff. I can't make that another retirement job. So we've got to figure out a way to make this process happen more rapidly. And you addressed that, I think, at our last meeting before. But that's got to be done. Otherwise, we can't function. We're here and we say, I can do this, and we can come back in October and see if it's done.
No, I understand. This has been a learning experience for us, or at least for me. This is my first venture into this. So there are a lot of things to learn from this and move forward.
Right, very good, please.
Can I just add one bit of color? So maybe on that same page, page 9, a couple of things jump out to me. I want you to have in your mind that the S&P 500 as an index is concentrated, but it's always been concentrated. It's a market cap weighted index. So by decade, it changes a little bit, like who's up at the top. ExxonMobil was up at the top for a very long time. But what's different this time around in terms of the concentration is just how concentrated it is around a theme, a singular theme, which is everything that Finney just talked to you about, AI and related. So that's one thing. It's a little different this time around, the concentration. The other thing that I want you to have in the back of your head is it's not just about the S&P 500 anymore that's concentrated. The chart on the lower left-hand side, that gold line there, that's the emerging markets index. You see how that's gotten concentrated.
Mhm.
Well, that is names that are subject to the same theme. Taiwan Semiconductor, Samsung, SK Hynix. They've been in the news over the last couple of days, kind of rolling over a bit, because the market's trading so much on expectations of future spend, future deliverables, memory, how much we're going to need memory and things like that. So think of emerging market as transitioned from, it used to be the picks and shovels of like nickel, copper, iron, still that. But today it's the picks and shovels of the AI boom, all the connectivity of AI. You need emerging markets to do that.
Yeah, source your blue jeans from China. That kind
And then finally, in terms of Milt, you asked the question how it's positioned. Finney, we all agree. I mean, your portfolio is structured such that it's not just about diversification of where you're at. It's how you implement as well. That passive exposure that you have in large cap is going to give you, that's the, how did we put it? That is the fear of missing out quotations. The passive's always going to give it to you. And then the fear of the bubble is complemented by your active strategies that are discriminating amongst those AI winners, right? And you might overweight or underweight. Now, what that could lead to is relative performance. That's what it looks like. So Aristotle and Jennison on the growth side, they've underperformed a little bit, but they're there for a very good reason, to protect no matter what the market does over the next 30 years.
Now, going back to the theme, I think people accept generally that this is going to be the most revolutionary advancement in our lifetimes. It's going to dictate the 22nd century. And therefore, it is terribly important that the only question is how fast can people go, how much and how fast they can finance themselves to move that frontier ahead. And they will go, and if they run out of money, Vinny, they just won't go as fast. It's self-correcting in my mind. It's going to be painful, but pretty much self-correcting. It's something we have to be cognizant of and participate in rather than shy away from. And we participate in it both with our passive exposure,
Right.
but also with our active exposure.
That's right.
Yep.
It's just a different approach,
For
but a
example,
diversifying way.
Sandisk isn't in the top, not in the top 100 companies in the S&P 500, but it's up. Good God, it's doubled this calendar year
Mhm.
because it's in memory, and there's a worldwide shortage of memory
Mhm.
between Sandisk and Micron and several, and the Korean company.
SK Hynix and Samsung
Yeah.
are the two what you would see, and that would be found in your Acadian portfolio. Now, that's a quantitative implementation, so they're going to give you exposure there.
Yeah.
That's just an arm's length away from passive. It's active, but it's just done systematically.
Okay, go ahead.
Well, no, it's a very important point you made, Mill, that it's not just certainly passive, we're getting this exposure, but it is within active. And Greg, mentioned Aristotle and Jennison, who certainly aren't as large as our passive exposure, but are, active. Jennison, for example, their largest allocation in their portfolio is NVIDIA. NVIDIA, it's a 10% weight in their portfolio. NVIDIA's it's up 50+% over the last year. But in the benchmark, NVIDIA's weight is 12 to 15%.
Mhm.
So again, it's still, we have exposure to it, but not as much. It's the same thing with Apple in the portfolio. Jennison has 6-7% in Apple, but it's double that in the index. And so it's a little bit of sizing is very important. And I do think, so with this theme that we're talking about, it's driving, it's going to be changing, but how the market has reacted to this, page 10, is very much really wanting to hop in and really wanting to make sure they own it, and gotten to the point where a lot of the market isn't necessarily looking at, all right, the fundamentals, what I was talking about earlier, that spend versus revenue coming in the door. This is an example of the small cap marketplace, but this would look very similar if we showed you the international marketplace, if we showed you other words. But what it is, these are the 4 different benchmarks within small cap. Russell 2000 is really small. Russell 2500 is SMID. We show core value growth for both of them. That's why there's 6 of them. But really the point of this is and it's really the green line. This is, a 1 year as of the end of March 31st. What is the performance difference with each of these indices? Stock performance of the companies that were profitable, that made money, versus companies that lost money. And so what you see, this green line all the way to the bottom, companies in each of these indices that had negative earnings, means they lost money, from a stock perspective, significantly outperformed, by some ways 20%, companies that turned profits.
Mhm.
And why is that? A lot of these, some newly generated companies, anything kind of focused on AI, the build out in the ecosystem of those larger firms on the spaghetti chart, the market really wanted to gobble up. And so this is one of those moments. You talk about how we set up our portfolio. We have exposure to this theme for sure, but we also think it's important that we have a lens around, all right, but does the price level justify where we're buying in at?
Mhm.
And we certainly think, and I think it's, we all know it's not sustainable to not have profits over a long period of time. Your stocks can certainly move up and down and be beneficial with what market is looking for, but ultimately having this fundamental tilt is very important to, at the very least, complement what we have in the portfolio as we move forward. And so really this has led to, we'll get into strong absolute performance that we've had. But for a lot of active managers, and it's not just in our portfolio, but really across the universe, have struggled over the past year. And it's because of
Struggle vis-a-vis what?
Visa relative performance. Have not earned as much as their respective indices. And a lot of it, I think, is summed up what's here on this page, page 10. A lot of the key themes that active managers look at: profitability, sustainable business model, quality of earnings, management team, et cetera, and this haven't been rewarded as much as the broad AI theme. And
I would also lay over on top of that. Some managers have limits on a given position. The market itself doesn't have limits, but some managers do. So in theory, you could take the top 50 companies with the limit on those positions, and the top 50 companies in the S&P 500 can get different performance.
Yeah. And
Very
and
true.
you're-
Even holding the same companies, you will wind up getting different performance levels just because the individual active manager can't, by policy, go over 5% or 6% or whatever their limit is on a given position.
this doesn't impact your plan in any way. You guys are big enough for this, but to Milt's point, the vehicle that you utilize can dictate that. Mutual funds. It's called the 40 Act rule, diversification requirements of a mutual fund. Says even if the manager wanted to own more than 10% in something, by virtue of you being in a mutual fund, and you don't have any here, so it's not impacting you, but to your point, TSMC is 15% of the emerging markets index, but
TSMC is Taiwan Semiconductor.
Taiwan Semiconductor. Managers by the 40 Act rule imposed by diversification requirements you can only own 10%. So even if you loved it, you're going to underperform the benchmark if TSMC
Yeah.
runs. NVIDIA,
Think
same
of the
thing.
same stock. Both portfolios, and the performance would be different just.
But the
because-
good news for your portfolio is you have commingled funds, things like that, where it's more customized and your managers can get market exposure, right? And a passive vehicle is not subject to those requirements either. So you're getting the exposure you need.
And so with this theme as it relates to active manager performance, page 11, again, showing within the active management community how much, as I said, they look at some of these fundamental things and they haven't been rewarded as much as the market. We've seen struggle across the board in the last year. So you all know we put together an active passive study that I believe we already presented earlier in this year, but I just brought back a few pieces of that. So I think it highlights and fits well within this theme that we're talking about. So what you're looking at is page 11. You see all the various equity indices, universes on the bottom of the page: US large cap, small, international, et cetera. What we're showing is we went back over the last decade, and I'm just going to use the large cap core on the left here as an example of this. And what we said over the last decade, what's the range of over and underperformance each year of the median manager? So the middle of the road manager for the year, what's the range? And so that's what this line is. So 1 year over the last decade, the median large cap core manager outperformed by just under 2%, right? 1 year over the last decade, the median manager, middle of the road, underperformed by 2.5%. And the average of the last decade are those little blue bars kind of around here. So we've kind of talked about it and know certainly within large cap, that's the harder area to outperform. That's why we're mostly passive within this space. But you can see across the board in other equity asset classes, that median, again, just middle one, is typically, this is all after fees, is right around or above positive return. These, call it maroon diamonds, this is the median manager in each asset class's outperformance or underperformance last year. So you can see kind of across the board, pretty much the worst year for active management over the last 12 months. And why is that? It's for all the reasons we have just talked about. It hasn't been the fundamentals, the profitability that have justified stock price movements. It's been the theme around AI and investors wanting to hold. And page 12, kind of last thing I'll hit on, is the same format of what I just talked about, the last decade, the range of performance. But instead of looking at actual over and under performance, what this is what percent of managers, active managers in each asset class outperformed just last year. And that's what you see. Basically, it's about 20% across the board. The range is certainly much wider. The average of all of them is higher. In most cases, it's above 50%. Saying, again, this is why we do our active passive study. In most of the asset classes, active management tends to perform over time. But 2025, particularly given all the themes we've talked about, one of the worst performing years we've had. Again, because of all the fundamental reasons we just talked about.
Thank you.
So a lot about the markets, what's been driving themes, interest. Maybe we can hop to page 15. Look at our portfolio. So as I said, portfolio now over $1 billion. First time the county has had this. Really, our last peak was before the 2022 pullback in the marketplaces, but we still weren't quite at $1 billion at that point. We were more around 900 million. We've more than clawed that back. And of course, keeping in mind, we're still pulling, call it $35-40 million out of our portfolio each year to make benefit payments. But currently, portfolio now over $1 billion. You can see where we sit versus our target asset allocation, which, as you all know, we do a pretty in-depth study with you all at the beginning of each year of where we want to be. At the big bucket levels, we're certainly well within line, our policy ranges for this. Not surprisingly, we're overweight equities right now, given how strong the market has been. And remember, we continue to pull back over the last year and a half. We've taken, call it $50 million out of our U.S. equity portfolio, really to support benefit payments. But all well within line, our ranges from an asset allocation perspective. So looking at page 16 for our performance. So again, at the top line, $1.03 billion in the portfolio. Through the first 5 months of the year, that's year to date, we're up over 8.5%, between 8.5 and 9 at that 8.79%. Again, all of these returns we're showing you are net of the fees that we're paying, and basically right in line with our policy index over the year. And as you look down kind of the line where a lot of this is coming from, within U.S. equities, for instance, that second row, we're up just above the index at 11.2%. Looking at where that's coming from, that performance, you can see, as I want to point out, U.S. large cap, we're actually about 2% behind the S&P 500, our large cap managers. And these are our two active managers that we just talked about, Aristotle and Jennison, just not owning really enough of the hyperscalers as much as within the index. SMID cap, small cap, I talked about significant rebound this year. Over most of the last decade has underperformed U.S. large cap. But on that first page I've showed you, we're seeing that strong rebound within small cap. So you can see our managers about 1% above the index. Now, keeping in mind, what's important to know for our portfolio, relative to the broad U.S. equity market, we own more small cap than large cap. In absolute terms, we certainly own more large cap than we do small cap. But relative to the broad Russell 3000 index, we have a higher allocation to small cap. This is why, as you look at the two components, while we underperformed large cap by 2%, outperformed small cap by about 1%, you would think we would have underperformed the Russell 3000, right? You just average those, but that's not how it worked. Small cap has done better, and that's what's helped add some of that relative outperformance. Within international, we've seen, you can see overall within non-U.S. equity, outperforming, again, as it did last year, our U.S. component. So far, year to date, up over 15%. You can see we have been doing a little bit better in the benchmark. We've been the managers here in a second. But ultimately, in particular, Silchester, who we added to the portfolio a couple of years ago, value, we've seen certainly start to do better in the international marketplace. So that's added value. I'll point out emerging markets. That line there at the bottom, as Craig mentioned, we've one manager there, Acadian. We continue to have exposure to the space. Overall, EM's an area that's been beaten up the last decade plus, but we've really starting to see that rebound. And again, why we diversify, have that exposure within the portfolio. Within fixed income, it's been basically flat this year with that expectation of interest rates rising. Our managers have done a little bit better in the benchmark. But again, as I talked about over the last year, our fixed income is up 6%. So again, certainly strong performance. This is something, as we started the conversation, trying to hit that 7.25%. As interest rates remain elevated, we're continuing to benefit from those higher rates. And then certainly real estate, we've talked about kind of a slow rebound from some of its, troughs into 22 and 23. Our managers have done well, but ultimately we continue to be optimistic about the space going forward. So those are kind of themes year to date. Again, as we look at over the last 1 year in particular, very, very strong, certainly absolute returns. We're up over 19% over the last year, but you can see we're trailing our policy index. Why is that? It's that same thing we talked about. These indices have really, really run, led by really a narrow margin of companies whose stock prices have significantly outperformed. We have exposure to those, but just frankly, not as much as in the index, which again, we think is part of that diversification, part of that protection throughout different environments within the marketplace. Hey, questions on kind of big picture level? Can look at some of the manager returns here on the next page.
I think I have a few. Can you just, when it says liabilities on page 20, what are we referring to? It says liabilities. Is that funded?
Eric, we're still on 17, I think.
Well, that's fine. I know on page 20. So what we're looking at here, this is what, Paul and his team calculates. We talk a lot liabilities. Really, from the actuarial, what Paul does, his team does his work on is trying, all right, what do we owe our beneficiaries over the next 30 years? And there's certainly things we know. We know what we owe our current retirees, and there's assumptions built into that. All right, how many people are going to retire next year, the year after? How long are people going to live? And so ultimately, there's a lot of calculations and analysis that go into that. And then really what this is saying is, all right, if you were to figure out what that is that we owe in 30 years, that total amount, and we call it, you discount it back, but basically, all right, we assume we earn 7.25% from now for the next 30 years. What amount do we need to have right now to earn 7.25% every year to match that amount? Okay. And this is saying really from that present value, that PBO 1.2 billion. If we had 1.2 billion right now and we earn 7.25% every single year for the next 30 years, it would get us to that amount that we need.
Okay, that was kind of clear.
And so that's where the funded status, we don't have 1.2, we have 1.03.
Okay, and then just piggybacking off of that, it says 81% funded here. And then Paul's report, granted, it was dated January of this year. The actuarial report gets 68%. How do we explain the 68% and the 81%, just so explain that?
But you remember when Paul,
68% is an actuarial based market value
And
as
this is-
opposed to a current dollar.
So a current dollar, right? So remember when, not just us, but all plans, when you look at our funded status, they call smooth it, which really just means we do it over a 4-year period. So we average, yeah.
Stop talking. You're wrong. I won't call you out like that. Again, I apologize, but I don't want you wasting time going down this path. What you're seeing here is a couple things. Well, really just one thing. I imagine the market value is playing into this, but really the fact is you're looking at something called an ABO, sort of an accumulated benefit obligation. So it's the value of benefits that people have earned to date based on service to date and pay to date. So if you were basically to stop the plan at 1/1/2026, you would owe $1.168 billion. Okay. And so it's a different actuarial measurement than that PBO that we're using for funding the plan, because the PBO is assuming that the people will continue working and continue earning additional salaries in the future, which would take up their liability and the ultimate benefit they get. So the reason why you have an extra, 13% in your funded status here is largely due to projections and pay on the benefits that people are going to get in the ultimate benefit they're paid. Does that make sense?
That does. So the actuary report does not include the projections, and that's why it's 68%.
No, the actuarial report does include the projected pay, so the liability is higher. And so the resulting funded status is a lower number.
Okay, thank you.
Because we only have 1.03 billion, right? And we need 1.2.
Right, but Paul, the PBO, you're just saying factors in those projections?
Correct?
That's clear as mouth.
Yep.
Sorry, Aaron, did you get your question answered?
Sort of.
It's hard to understand. I understand that, but it's more an actuarial concept. The ABO can be thought of as the liability for the plan today, as if you stopped accruals, and the PBO is sort of that ongoing plan saying, if we're going to continue earning benefits, here's what people are going to have a liability of.
So the PBO includes and anticipates raises.
Correct.
And it's 81%. The actuarial report also plans and includes for raises, but it's at 68%. So I don't understand the difference yet, and that's.
No, the 81% here, I think, is based on the ABO, right? So it's using that 1168 number. So the reason that you're getting a higher number is because you aren't including those pay increases.
And Paul, that dark blue line underneath it, it's the most similar, and you see how that's like 72?
Yeah, agreed. And
The
so
s-
the reason why that's different from the 68, I imagine, is that market value versus smooth value.
Right. So that's what Finney was going with the dark blue line.
I'm sorry.
Yeah, so.
I'm sorry, Finney. I didn't mean to step on you. I just saw the 81 and thought that was going to derail things.
No. That dark blue line is market value today, which he didn't have as a report at $1 billion. Plus, Paul, I think it's 2022 when we had the drawdown. That is still being contemplated in the report that he delivered last month.
Gotcha.
Whereas here, you're just seeing that back in, you'd have to go back to see where that dark blue line around, if you can bring your eye back maybe a quarter of the page to the left.
Mhm.
You see how it was down in kind of that 60s?
Yep.
Right?
Mhm.
He still has that in that 68. So that's accounting for some of the difference between the 72 and the 68. It's just the
Exactly.
market. Right now, you got $1 billion. Back then, you had something
So-
less than $1 billion.
So, sorry, are we smoothing over 3 years or 5 years?
I think we're 4, aren't we, Paul?
I think we're 4, yeah.
Okay,
Yes.
so the 60 goes back to February of 2020, which would exceed the 4-year period.
No, I meant like, that is why it went down, like, that drawdown was the market drawdown in the assets.
Mhm.
That green line keeps going up, right? So that impacts, Aaron, that 1 billion,
Mhm.
31.
Yep.
Divided by the 1.2 billion,
Okay,
that gets you to the 71.
okay.
It's telling you how much do you have in dollars today to meet that dark blue line.
Okay, that makes sense. I appreciate it. Thank you. That's so the dark blue really uses the PBO.
That's the closest thing to what he was delivering
And
last
then
month.
the gray one in the middle uses the ABO.
And the only reason why this has been in this report for 15 years, I remember doing this back in Summit Strategies days, and it was just a mechanism.
Else.
What Paul gives you is the actual number.
Those are the numbers, but they're also as of December 30th.
This is intended to give you a more live picture of as the assets grow, what it is.
So
It's supposed to be complementary to what Paul delivers.
Paul,
not-
for perspective, what is the actuarial value of assets you have as of 12/31?
I'm sorry, Finney. I don't have it right in front of me. I can pull it up if you give me a minute.
I think it's around 900.
But I think we're getting a little bit like lost here. I think the most relevant number is what Paul has given, that we are at 68%.
And I thought the 68% was as of year end 2025.
Yeah, I
That's
mean,
correct.
we can, these are super sensitive numbers based on discount rates and whatever else, and you get huge fluctuations. But I think Paul is, following a certain guideline, and I think for our purposes, we should go with that number as, the most relevant number here.
It is the official number. That's what we've published.
Yeah, I don't want to, we may get lost in the minutia otherwise.
Excuse me. Captain Schaefer had a question about the presentation and deserved to have that question answered.
No, absolutely. I'm not saying his question was wrong at all. I think it's a very relevant question. I'm not saying that he asked the wrong question or we are, not answering something. I'm just saying that I think for our purposes, I just want to, saying that 68% is our funded ratio. That's the most relevant.
Thank you, Paul. Appreciate it.
Okay. Is there anything else?
No, that's all answered. Thank you.
Anything else that you would like to say, Phineas or Craig? Anything else? Go with your report. Or
I think we've covered a lot, and I think kind of hit on the main themes, but certainly happy to, take the conversation wherever we would like.
okay, then we'll move to the next item on the agenda, and that is RFP update. So RFP update, and Becky will give us her thoughts on this.
So, as many of you all know, over the last year and a half, we've had quite a bit of substantial changes with the addition of Workday. We were supposed to go live in June with that. It has been postponed until September. Is that right, Steph?
HR September, financials October 1.
For October. With that said, it has certainly taken up a lot of our time and more time than know we ever had. Getting John on to replace Maggie, and then Levon replacing Henrietta, who replaced Vicky. We have been in a year of trouble. Not because of them, but because of turnover. So that said, I can't touch this RFP right now, at least until October, November. I have no time. I have the last pay period, I had over 100 hours. So, and that doesn't include all my hours, but I don't have time right now. And as you know, we've had the turnover in other areas. My team and I have picked up. Rachel stepped up a lot. And as most of you know, I've been in and out of work with my daughter who's in the hospital, or was in the hospital. So the RFP is stalled because of me and lack of time in my schedule right now.
Okay, what is your best guess as to when?
I'd like to have you guys
Process.
draft by early December, if not November.
Okay.
All right.
Any questions or comments? Okay, fine. That's done. Item number, so we've covered the actuarial. Item number 8, implementation status of previously approved new investment managers. We sort of covered that previously as well. And therefore, we're now at the, is there any other business that the board would like to bring up and discuss?
Well, if
Or particularly for the next meeting?
if Levon's on, can he provide an update? 'Cause
Yvonne was on, I thought, at the beginning.
Just needs to
Oh,
undo.
there he is. The initials are there anyway.
Is he muted?
Yeah. He's there. Top right.
Levon, maybe unmute.
IT said we can't do it from this side. He has to do it. That's another thing, so you guys know, IT is turning over these meetings to us to run with this new setup. Now they're eager to release the training wheels, so I stalled as much as I can. That'll be with us since,
Well, we can't get Levon apparently, he's lost at sea. All righty,
No,
there we are. Okay, yes.
I'm going to make an editorial comment and I'm going to put my mouth where it's none of my business. So I acknowledge that up front. But if there are people in that room or on this call who have any sway or ability, y'all need to get Becky more help. Or her department more help, because if I ran my business like this, I would be out of business. It's not sustainable. And as I said, I know that's not what I'm on this board to comment on, but I feel like it needs to be said, and I don't know who the appropriate party to acknowledge that to is, but
Pepe, I think
there's anyone on this call who can affect change.
Pep, your comment is well taken. I share your sentiments there. We as a board have limited ability to really influence that. We can't even get somebody appointed to the board in spite of the fact we're running a $1 billion portfolio. Nevertheless, though, that comment is well taken, as same as the comment that I made earlier, that it's unsustainable for us to make a decision and the decision is not carried out for 6 months because it has to go through various chairs and sometimes the chairs don't know that they should be involved in making decisions. Other comments? Marion,
I have two comments. One was,
Marion, I just want to make certain they can pick you up, your voice up, that's all.
well, I can stand. I have a question about what happened to the ordinance changes that were proposed last fall. I thought at that time in October it would be presented, and where is that?
That continues to be in purgatory or limbo, depending on one's faith. They were all submitted to the county executives and his staff for review and approval. That was never done. Now we have a county council, as you know, that wants to put a hold on everything, almost everything, pending the appointment or the election, I should say, of a new county director. So that document that you heard, that has not changed at all. It just is.
Is it still in the county executive's office, or has it ever gone to the council?
It has not yet gone to the council, to my knowledge. And things go on here that which I have no knowledge, but to my knowledge, that has not gone on. Everything is just at a standstill on major decisions, it appears.
Okay. The second thing was just a comment I had, kind of what you talked about, Aaron, at the 68% that was mentioned as funded strength by Paul earlier. That's from 6 months ago. It's last December 31st funded strength. This report today shows we're at 81%, which is a significant difference. And 80% is always the figure that you quote, Milton, is what's needed before we consider a COLA. So it's interesting to me that we are much closer to that now, or actually 81% at this time.
Mm-hmm.
And I would hope the board would consider that. Thank you.
Thank you. Anything else? Any other visitor comments?
Yeah.
Yeah, David?
Everybody could look at page 16 on ACG's report. I just want to look at that top line, well, the top two lines. Every single 1 year, we're under 2.42%. 3 years, we're under 1.68%. 5 years, we're under 1.6%. Then we finally come up to about after 10 years. But this doesn't seem to be good. And that's all I'll say about that. The comparisons of funded ratio, other plans in Missouri were much higher than St. Louis at the beginning when the guy was telling us that. I guess that was Paul. All of them give, and all of them give annual COLA. So we're down here, we give no COLAs, and they're up here, and they give COLAs. That also has to be some indication that something is not right.
David, if I can interrupt for just a second. Some of those are mandated by law.
I don't care, Milt, that you keep saying that. It doesn't matter. It doesn't change the fact that they do give COLAs. Therefore,
It does
if
change the fact that they do give COLAs. Some of them, for example, I had Foster, but look at this for me several years ago. Some of them are giving COLAs even though they are substantially lower at that time in funded ratio than we were, because we're mandated by law. Some of them, on the other hand, are prevented from giving COLAs if they're directly under state regulatory authority. So it's a mixed bag of organizations. And whether or not the St. Louis County gives a COLA versus Cole County doesn't have any pertinence really. So, but your point is well taken, that we ought to continue to consider giving a COLA.
you're saying that if these funds that they're talking about, which have a higher funded ratio than we have, and they're taking money out for COLAs, that doesn't impact the funded ratio at all?
I didn't say anything of the sort.
Well, that's the point I'm trying to make, and then you interrupted me. So,
Just
And
to say
this-
some of them are mandated
the
regardless of funded ratio.
the
Go
actu-
ahead, finish your point.
The actuary study in 2018 put St. Louis in the bottom quartile of all the plans in Missouri. I can't imagine that we're any better off now. At that point, Mr. Wilkins asked somebody in the county to reconfigure that, relook at it, and it didn't change anything. So and Mr. Wilkins today, what did he do? He said, oh, take a look at it when this or this. And we haven't, over the last quarter century, we have not averaged 7.25 over the last quarter century. And back on page 216, the life of the plan, we're down 54 basis points. Do you know how many hundreds of millions of dollars that is over that time? Craig, you got something to say? I see you.
No, keep
I don't
going.
wanna
I don't
hurt
want,
you,
I don't
man.
want to enter, no,
Okay.
no.
But anyway, the other thing, if we had a passive portfolio, we wouldn't be worried about these strategic implementation plans because we'd have our allocation worked out. We'd have our index, and we wouldn't be worried about implementation. And we've lost over 50% of our funds. So we're not good at picking funds. If we were good at picking funds, we wouldn't have this turnover. Thank you.
Any other comments? Joyce,
I just had a couple.
please.
I was listening to everything, and I will say, I worked for the St. Louis City Juvenile Court, then I worked for the Missouri Division of Youth Services for 14 years, and I was only at the county for 30. So that's 45 straight years. I did that whole thing about the public pensions, and we're the only one of the very few that doesn't do a drop program. And we don't review a COLA on a yearly basis. And the last 10 years that I worked, I didn't get a raise, and I have never gotten a COLA. So, I've been retired since 2018.
So you were not in the two groups that did receive a
No,
COLA?
I advocated before the council and everything, but no,
Mhm.
I never got one. So I have been stagnant for all those years.
Mhm.
And I will tell you, I worked a lot of hours that didn't count, but I did the best I could do. But I am really suffering because my thing is the same. My little Moser's thing goes up a little bit every year.
Yeah.
And it's very hard for me to maintain. That's all.
Mary, let me ask you a question. As president of the civilian retirees, have you ever put together a group to actively lobby the county council?
It's difficult to do that because of lack of access to them. I don't have emails of 3,500 retirees, and that's the logical way to communicate. And in recent years, the methods that I use to gather emails at insurance meetings annually or retiree ceremonies, those programs don't exist anymore in that format. So I don't have access to a large number. Those that I have, several hundred, I do communicate with them regularly, and I try to let them know what's going on at the board meetings.
Okay. Thank you. Appreciate it. Anything else? All right, there is no reason to go into closed session unless somebody has something they wish to say that cannot be said in open session. So if there are no such requests, I'm going to call for a motion to adjourn.
Move to adjourn.
Second. All in favor?
Aye.
Unanimous.